Politicians see the provincial debt through the lens of party and politics, and they meet the voters for their verdict. Economists gauge debt by different metrics and from different perspectives. Joining us now for the Economists View, Sheila Block, senior economist for the Canadian Centre for Policy Alternatives, and Rosalie Wanch, policy analyst for the C.D. Howe Institute. And Sheila, it's good to have you back, and Rosalie, for the first time, nice to have you here as well. Let us do one of life's most interesting experiments, which is to show you the same thing and see if you both see the same thing. Mr. Director, if you would, Ontario's debt. Let's bring that chart up. And there we go, all the way from 50 years ago, or I guess 35 years ago or so, when Ontario's debt was around the $30 billion mark, and now, of course, projected these days close to $312 billion. Okay, Rosalie, let's put you to work right away. You look at that, what do you see?
Well, what I see is that we've got, a certain sort of trend of linear debt growth going up to the recession, and then really a different line that follows that after the fact that has our debt growing at a much higher rate than before. And while, in an economic downturn, there's a good economic argument for potentially increasing the debt, we're now a full decade almost from that recession. And so it would be time to start looking at maybe bending that curve down a little bit.
Sheila Block, what do you see?
Well, I see a number without much context. So that $312 billion is really a lot if you look at my household. It might be even, it's a lot if we look at all three of our households. But you really want to put that number in context. And what you'd want to put it into is the context of what's the share of GDP and other things. So it's really kind of hanging out there on its own for me.
Well, we know, absolutely right. Let's put it in context. Sheldon, you want to bring the next chart up? Here is Ontario's debt as it relates to the percentage of the economy, the goods and services produced by the province of Ontario. And again, if we go back to the beginning, 35 odd years ago, whatever it is, now I guess we're only going to go back 25 or so years here, you see as a percentage of the economy, the debt was quite small. But two big recessions later, and now we're up well over 30%. And although the budget numbers in the last budget brought out almost 3 weeks ago suggest that line is going to start to trend down as opposed to up. So now that we know, in terms of context, Sheila, do you want to say anything different about that?
I think we want to look at it in that, when we look at it in that context, and what we see is that debt is fairly stable, it's fairly manageable. We have to remember that if we look at it over that long time period, there's been a lot of change in how we measure it. Things have been moved in that hadn't previously been in. So in terms of the debt. So I think what we're seeing is a fairly stable debt level.
Is that what you see, Rosalie?
I would say that while there has been some recent progress in stabilizing the debt to GDP ratio, what I would point out about that graph is that it's actually going up for 4 years almost, and it doesn't start to trend down again until 2022, 23. And so really what we see in that budget is a commitment to increase the debt to GDP ratio over the next 3 years and then maybe manage it after that. And as we could look back in budgets and see how good governments have been at meeting their commitments more than 4 years ahead of time. And really, I think that anything past the commitments that would be within their control is kind of something to say, well, it's hard to say it's a good news story if you're increasing the debt to GDP for a short period of time.
Well, the commitments that are within their control are another 2 months, right? We're going to have an election 2 months. After that, who knows, right? So you're saying 7 years down the road, this could be fiction is what you're saying, I presume.
Well, in terms of taking things with their relative context, many things could change. One of those being the level of GDP. If there was, say, an external shock, something that affects the GDP of Canada and Ontario, or perhaps another recession, well, our debt level stays the same and our GDP may drop. And so at that point, then our debt to GDP jumps, not because our debt has changed, but because our GDP has changed. And that has negative impacts on government revenues. And then it really starts to make the idea of financing our debt a little bit more questionable.
Sheila, at what point do you, again, putting it in context, at what point do you get nervous about how much debt Ontario is carrying?
I think you start to get nervous for a couple of reasons. One of the things that's really important is what share of your interest payment, what share of your total revenues are interest payments taking up? Because what that says is that really limits the ability of government to do the things that we want them to do, to spend on healthcare, spend on education.
Well, it's about 10% now, isn't it?
It's about 8%.
8%? Okay.
And it's actually been falling. And that's not due to any virtues of the government, but that's because interest rates have been falling. So you want to look at the capacity of the government, and you also want to look at the capacity of the government to withstand shocks, as you were suggesting. And so I think there's no crisis on the horizon here.
So 8% is a manageable number in your view?
8% is lower than it had been, and it's a manageable number. I think we want to really pull back and look at the picture a little more broadly, because absolutely, if spending increases the potential of GDP, increases productivity, increases efficiency, like some of the spending that was proposed in this previous budget does, then you're actually growing the denominator, you're growing the GDP, and you're actually reducing that debt to GDP ratio. So there's potential on both sides. Absolutely, there'd be a big concern about approaching a debt crisis, one of those where you have trouble selling your debt. There's been no indication that we're anywhere close to that at the moment.
8% doesn't sound like a huge number. However, $12.5 billion a year, third highest number in the budget after healthcare and education. Interest on the debt is number 3. That does sound big. You want to put a different kind of context on this?
I think, well, actually, I'd like to maybe same context, slightly different spin, which is I would agree that what we would be concerned about in carrying this debt is that the payments on interest start to take up a larger and larger share of government revenues. And so while there's been progress made on that front up to this point due to lower interest rates are now increasing, and the budget itself projects that interest rates will take up a growing share of revenues. So it's one of those things that, yes, but that has been a windfall that had to do with monetary policy and low interest rates, more so than Ontario government spending.
Gotcha. Let's do the analogy, we did it in the last discussion as well, and let's do it with you two as well, and see whether or not there's something instructive to learn from here. I think we get good debt versus bad debt. Good debt, you want to buy a house, that makes sense. Bad debt, you're not making any money, but you want to go have a weekend in Vegas that you can't afford and put it on your credit card and worry about it later. That's bad debt. What's most of the $312 billion that Ontario is in debt right now, Sheila? Do you have a view on it?
I think there's a number of components of that. So some of that is, the mortgage payments on the house in terms of infrastructure investments that we've really been needing and crying for. Some of that has to do with social investments. So when you think about, let's say, childcare spending, that is actually an investment in the future. It's the investment in women's economic independence. It's an investment in sort of child development. But I think we really need to pull back a little bit from this debt conversation. And something that seems to be missing is the two sides of the equation. There's spending and then there's tax policy. And so if we really want to pull back and we want to say, what kind of, are we raising enough money to spend and pay for all the services that we need in this very different and very changing economy?
What I'm inferring from that is you're not outraged about the size of the debt, but you are a little bit outraged about the fact that the government wants to only borrow from future generations to pay for these services rather than increase taxes on the people who are actually going to be enjoying these services. Am I hearing that right?
Almost.
Okay.
And so I think that future generations will be benefiting from these investments. I mean, we can think about what would our lives be like without Medicare? Governments have to make decisions to make those kinds of expansions. But I think to really solidify them, to maintain them, then we have to make those payments both for our generation and next generation, and each generation has to do that in turn. So I really think we really need the kinds of services that are being proposed in terms of, where the economy has changed, how this shift has been, where businesses have really pulled back from some things that they used to do. We need to do them together and collectively, but we also need to pay for them.
Okay, let's leave tax policy out of this for a second and go back to the original question. Of that $312 billion of debt, how much of that is sort of mortgage payments on the house, which we have to make and which keep us sheltered and therefore it's good debt, and how much of that is we wanted a weekend in Vegas that we can't afford and therefore it's bad debt?
Well, I think that, it's a little bit of both, where, infrastructure is something that those are large projects that are costed out over years. And, that really is the mortgage. We need roads, we need bridges, we need schools, we need hospitals. Those are things that, we are all willing to pay for in mortgage. However, I would say that the argument to take on debt for social spending, and especially when that argument goes with for the generations of the future, well, that's essentially the voters and taxpayers of today saying, well, we're investing in the voters and taxpayers of tomorrow and they'll be okay with it. So
What social spending would you be referring to?
Well, this is just, if we are going to be debt financing for program spending and not for long-term investments, then it really is the balance between, are we taking on debt or are we going to pay for it now? So that's sort of where I'm bringing in tax policy again a little bit.
I was going to say, you sort of agree with Sheila on that we ought to pay as we go.
I would like to point out that even for the spending this year, 2018-19, this year's budget relative to last year's budget contained $14 billion more spending and $7.6 billion more revenue, which means that $6 billion deficit, also there's $7 billion in more revenue. So that revenue has to come from somewhere. So it can come from the crown corporations in consumption, it can come from taxpayers. So at the moment, we're doing a little bit of both. And I think that it's not so much that we could take each individual program and discuss it on its own merits. However, when we look at the overall picture, then we're spending, they're spending $14 billion more than this year than they planned on spending last year, and they're only getting $7.6 billion more in revenue. So on a short-term year-over-year basis, you're getting more credit card debt than you're paying off.
So you do agree with Sheila then that the government should have raised taxes on somebody in order to meet that shortfall? Well,
I think it's very easy for people and just generally to think about all the things they would like the government to do. And really, we all enjoy government services and, we all need roads, schools, hospitals, doctors, and all of that. But when we disconnect that from taxes, then it becomes really easy to let our spending our appetite exceed our stomach in a certain way. Because if the government had to pair tax increases with its additions in spending, then voters could make a more informed decision about what programs they are actually willing to pay for.
I guess, Sheila, if the government didn't want to raise taxes on whomever to meet these new spending obligations, the other alternative would have been just not to spend that much. Do you approve of that idea?
The idea
of just spend less. If you don't want to raise taxes on the current generation to pay for these programs, don't introduce the programs. Is that an option?
I think that's an option. I also think that we have to really be clear about the differences between governments and households. It's a kind of nice, manageable metaphor. But, there are intergenerational responsibilities and intergenerational taxing powers that governments have that households don't. But I do think that there is a call for some kind of honesty in that way, and to say, look, we really think the economy's changed. We think there's a new role for government here, and we need to pay for it. And taxes are a great way to pay for those kinds of services. It's efficient. You take advantage of economies of scale. You pool your risk. There's a whole argument for governments being like a kind of giant Costco, and I think we should be making that argument much more frequently.
Okay. Let's, in our remaining few moments here, let me put this on the table here, Rosalie. Are we reaching a point, in your view, where the size of the Ontario debt, not only in bulk number, but as a percentage of our economy, is getting to a point where banks are looking at the economy of the province of Ontario and thinking, you're not as good a risk anymore, and we just may not lend you money? Are we there? Are we getting close to there? We're not there yet, obviously, but are we getting close to there?
I don't think that that's where we are, but I think that, I would argue for being slightly cautious, because there are external risk factors that aren't so much about the fiscal position of the province itself.
Like what?
Like GDP, and that, yes, we can make investments in it, but GDP isn't within the control of any particular jurisdiction or government. And shifts in world markets can, add risk. So if we're putting ourselves in that territory where we're kind of skirting the line, where if there was a downturn, then we could potentially be in a position where we wouldn't have the ability to expand spending in the form of government stimulus to actually, help in the recession the way that we did nearly a decade ago. And beyond that, government revenues would take a hit because of that lower GDP. So it's really that it's not that we're in a risky fiscal position at the moment, it's that due to the fact that these things aren't completely within the government's control, that we should be a little bit cautious because they really are walking the line.
True. One of those things is a rise in interest rates, which I suppose most economists are anticipating eventually. Interest rates go up a point, that costs the province of Ontario hundreds of millions, if not billions of dollars. Are we ready for that?
I think we're pretty ready for that because the Ministry of Finance and the Financing Authority has expected that and has gone really long on Ontario debt. I think I would have
Just explain what that means, has gone long on Ontario's debt.
So what that means is that you lock in long-term debt. And so what you're doing is you're kind of protecting yourself against interest rate risk. I think I would agree with you that the bigger risk is the risk of another recession. And we know that recessions come. We just don't know when they're going to come. And so in terms of both the negative impact on revenues, the need for more spending, that's where I would have more of a concern about the fiscal position. I think I agree with you as well in that I don't think we're anywhere near a borrowing crisis or a fiscal crisis.
We're not Greece yet, are we?
We're nowhere close to Greece. We are nowhere close to Greece. And even after the last budget, while the rating agencies sort of announced their displeasure, there wasn't another downgrade. So I think that's a pretty strong signal.
Although, my recollection from my childhood, as many years ago as it was that the province of Ontario always had a AAA credit rating, and we are nowhere near that anymore. What are we right now? Are we A+ or something, or AA? We're a long way from AAA anyway. That means when we borrow, we got to pay back more. Should we not worry about what the size of the credit rating is?
Well, absolutely. I think we should worry about it sort of the same ways that we should worry about the debt to GDP in the context of that the government doesn't necessarily control GDP. And so that can quickly shift without changing the debt level. So it's similar to our credit rating. The better our credit rating is, then the lower we can actually borrow for. So just the more we borrow and the more that could potentially negatively impact our credit, then just the more the financing of the debt and the cost of interest becomes more and more of a concern. And as we've already seen, or as this budget has shown, they expect that those interest payments are going to take up a larger share of revenue for the coming years.
And that's our time. That's Rosalie Wunsch, policy analyst with the C.D. Howe Institute, Sheila Block, senior economist with the Canadian Centre for Policy Alternatives. I want to thank both of you for coming into TVO tonight, helping us out with this. Thanks so much.
Thanks for having us.
Thanks a lot.
The Agenda with Steve Bacon is brought to you by the Chartered Professional Accountants of Ontario, helping businesses stay on the right side of change with strategic thinking, insightful decisions, and business leadership. Are you on the right side of change? Ask an Ontario CPA.